All right, just making sure everyone's awake this morning. Here we go. All right. How's everyone doing today? Good. All right. Avoided our first potential snowfall of the year so far, which is always good. So what we're going to be doing today is moving into a slightly different area of our tax topic. Last week was probably our biggest area of actually making a whole lot of decisions in terms of filing status dependency. But what we're going to be doing today is really talking about items of income, areas that are going to be showing up on the return, and how we're actually going to be going ahead and using the information from the clients to start preparing the income tax return. Now, today what we're going to do is go through all the possible areas that we'll see that the tax rate or the tax liability will increase. Next week's a whole lot more fun. We'll talk about deductions and credits and start taking that away from the government. But today we're going to start talking about how the actual tax information is going to be coming in. Okay, so getting a little fast here. All right, so one of the first things we're going to take a look at are what is considered taxable income. And it's a great question to ask the IRS, because if you ask the IRS, they're going to say everything that you ever get is taxable income unless we tell you it is not, which is actually the definition of what they mean by taxable activity. But what we're going to take a look at are the common ones that we'll find within VITA. This list is boiled down a little bit. This doesn't mean, and I don't want to scare anyone, you will not see all of these during your VITA program. It's just the ones that could possibly be happening within kind of the VITA approach. These are going to be found on D1 of your 4012. The top ones we're going to be taking a look at in a lot more detail. Things like wages, taking a look at dividends and interest, retirement distributions. But there can be a lot of other things as well. Alimony is considered taxable income. Other things like annuities, which also be part of our retirement distributions. Gambling winnings are still taxable income. Things like military pay, jury duty fees, refunds of state taxes. We'll talk about this a little bit because I think we're going to see fewer and fewer of actual refunds of state taxes, local taxes becoming taxable due to our filing situations. Social Security benefits. You may get people who come in and say, I'm a senior, I don't have to pay any taxes anymore, right? No, there's no exemption to say once you reach a certain age, you don't have to pay the government any money. Now, you may not have to, but you still have to file income tax returns and part of your benefits may still be taxable. So we'll talk a little bit about Social Security, a lot more of our common ones. So when we go through, there's a lot of things that are going to be considered taxable income, but a lot of the questions we actually get are related to the next slide, which are what is not taxable income. So there are a lot of questions that we sometimes get. Someone says, well, what do I do about the gift or inheritance I received? How much do I have to pay on tax on that? It's a great answer. The answer is nothing. There's no tax on gifts or inheritance. Likewise, things like child support, damages for physical injury are not taxable. Insurance proceeds, so if you're getting money from an insurance company, typically not a taxable event. Anything that you're getting from sickness or injury payments are typically not taxable. We'll take a look at some forms coming up here that'll help us determine that. Any welfare payment, any workers' comp payments are not taxable as well. So the general rule we have, if you're getting paid to work or not work, in the case of unemployment, it's going to be taxable. If you're getting paid to not work because you're sick or injured, it is not taxable income. So payments on account of illness, injury, sickness are generally not taxable. So we have a fairly long list here of not taxable items as well. Again, found on the bottom part of your D1. Unfortunately, this list is not as long as the first one, where we had to go to about 8-point font on the slide to get everything to fit in. But there are a number of items here that are considered non-taxable income that we often get questions for people coming into VITA. The main thing we're going to take a look at, again, the common ones. These are going to be the things that we're going to boil down from that first page and really kind of focus in on the things that you're most likely going to see, particularly with basic certification here within the VITA program. What we're going to see is that these changes are going to be occurring. You may have a copy of the new proposed 1040 in front of you. So some of these things change around a little bit. They decided that having a first page of just all blank information didn't really make a whole lot of sense. So what we call page 2 is actually now kind of the postcard part, page 2, which got moved up to the front for the print version. So people used to see numbers on the front of the return will now get to see numbers on the front of the return again. Now, the main things we're going to take a look at, the 5 categories that we have here, are typically going to be showing up on the front page of the 1040. These are going to be your top line items, the ones that are going to be most common to the VITA program. Those are going to include wage income, we're going to see interest income, dividend income, retirement income, and Social Security benefits. Those are our primary sources of income that you'll see on the front of the 1040. The government has decided that any of the other ones are traditionally going to be on a Schedule 1 or a supplemental schedule. That's where we'll find things like our unemployment compensation, things like gambling winnings, anything that doesn't quite fit on the front is going to be on a Schedule 1. So a lot of those haven't really changed from last year, just a little bit of presentation. So just to help go through, this is a W-2, for those of you who may not have seen one. So anyone who actually has wage income paid by an employer will be receiving a W-2. It is supposed to have been received by the employee by January 31st. Hence, we have a huge rush in the beginning of the season as people are trying to get their taxes in and filed for refund purposes. But this should be received by the employee by January 31st. What we'll see here on the W-2, it'll provide a lot of information. The one downside is there's no set format for a W-2. All the boxes will always be there on every single W-2, but they may not always be in the exact same place you're expecting it to be. So just want to kind of mention a couple things we'd want to take a look at for the W-2. When you get a copy, the easiest part is you're simply going to enter it as you see it in tax layer. So there's not a whole lot of thought process that needs to go in to say, okay, now what do I do with this? When you see box 1, enter the amount from box 1 into tax layer, box 1. So the process goes fairly easily here. A couple things that we want to take a look at is just making sure we understand whether this W-2 belongs to the taxpayer or the spouse. Also watch that if you prepare returns for children, that the parents haven't slipped a kid's W-2 into the tax return with you and you're trying to enter that. Hey, good news, you can probably set up a second return for the child to go ahead and file a return for them as well. But we just want to basically put the taxpayer or spouse. That's going to be indicated obviously by the employer name and address. We do need to enter most of the information here on the W-2. The fortunate part, if this is a returning client to the VITA program and they had the same employer as prior year, all of the basic information will populate over. You don't need to re-enter the EIN, you don't have to enter the employer address, all of that will come back over again. Now, the unfortunate case, you may have an individual who decides that they would like to see how many employers they can get for the year. So you will have to go ahead and enter the W-2s in each and every time. Another benefit too, though, when you see the employer identification number, obviously when you get a W-2, it's going to actually have something other than X's in there. Once you enter that employer identification number, if someone else in the system has already entered the W-2, it's also going to pull over all the employer information. So the nice part is if you're not the very first one to enter it, someone else has already done most of the work for you. So then after that, we'll take a look at some of the boxes. We want to be sure that we get all the information off the W-2 reported correctly on the income tax return. The most important one for federal income tax is going to be box 1, which fortunately is labeled 1 for sake of convenience. That's going to be our taxable wages for federal purposes. The second one we want to enter is going to be box 2, which is going to be our federal income tax withheld. Now, what will happen, the system will automatically try and assume that our federal taxable wages will be exactly the same for Medicare, Social Security, and PA, but it often is not. One of the differences we have here in Pennsylvania is that any contributions to a retirement plan made by an employee through an employer-sponsored plan is not a deduction for state taxes. And you think, well, that sounds unfair. The feds allow you to do that. Here's the benefit. Pennsylvania doesn't tax you on retirement distributions like the federal government does. So when we talk a little bit more about some state and local differences, Pennsylvania does not tax you on retirement distributions. So when your money goes in, it's not a tax deduction, but the full thing comes out effectively tax-free. So quite often we may see some differences between your federal taxable wages, your Social Security and Medicare wages, and your state taxable wages. So the system's going to try and make it easy for you, but it doesn't always do it right. It's trying to do something nice for you, but you may have to go ahead and just type over that information. So just again, enter the information you see on the W-2 as it's presented. The information on box 12, which we don't have it in our example here, but that will contain information that's going to flow to other areas of the tax return. Things like retirement contributions, things like if we have a code W for someone participating in a dependent care process, things like HSA contributions. Other items might be how much they paid for medical insurance. If we see anything in the box 12, we highly encourage you to just enter the box 12. The codes are already pre-populated and will help move to the correct section of the tax return. Things that are in box 14 will not go anywhere else on the income tax return. They're mainly there for your information. So if you want to practice your typing skills, you may enter that in. It's not going to go anywhere. So we'll just tell you how to use that information in box 14 for a couple other purposes. A couple other things we'll take a look at is making sure we have our state and local wages. Again, we may have some differences between federal and state. So it's important that when we get to the bottom section of the W-2, that we want to enter the state appropriately, the state number, so the state can actually match up the information. And again, the state wages are typically, they may be different from the federal. Again, the main difference would probably be things like retirement contributions. Other items might be if they participate in a group term life insurance policy, a code C in box 12, that'll also be a difference there. And local should generally be the exact same amount as state. State and local follow the same rules, so they should generally be the same. So we want to just be sure that we're entering state and local wages in the appropriate boxes. The nice part again here is once you enter it in, it's actually going to flow over to the correct aspects on the return and allows for easier reviewing. All right, so that's number one, the W-2. Again, fairly straightforward in terms of application. If you're lucky enough that someone else has already done the W-2 before, you don't have to retype that much. It's just really some numbers you have to enter in. The next thing we want to take a look at is a 1099 INT. In the 1099 series, you're going to be reporting information coming from other activities, generally sales or holdings of property or some other type of information. The general rule that we tell people, if you have a form you got that looks official and has a 1, a 0, a 9, a W, and a 2 in it, give it to us because the government also gets a copy of that form. And there's ways that we can go ahead and enter this information. When we get to the actual application process, there will be a couple ways we can show you how to enter the information. We can go through kind of a process of understanding where this should be on the return, understanding the income. The other nice feature that TaxSlayer has, if you don't know where it goes, you can simply type the form number in the upper left-hand corner and it'll automatically guide you to the appropriate entry spots. Interest and dividends are typically going to be coming off of individuals who have investment accounts. Not to scare anyone, we may not see a whole lot of 1099 INTs. And the reason why is because the bank does not need to issue a 1099 INT if you have less than $10 of interest income. People may bring in their bank statement and say, I don't know why the bank didn't give me a form this year. I got interest income. And they bring you your statement and they say, I've got 26 cents of interest income off my interest-bearing checking account. You're more than welcome to put 0 or $1 down if you like. It's not going to change the income tax return. But typically the 1099 INT is only going to be issued if you have $10 or more. In this case, we have an individual who has $56 of interest income. No offense to the bankers in here, but probably means you have about $1.3 million in your interest-bearing checking account to get $56 of interest income. So they may be within or without VITA scope, we're not entirely sure. But what we want to take a look at is entering the information off the 1099 INT, much like the W-2. These are a little bit more kind of common looking forms. Usually people use a more generic 1099 INT, but again, they may take different shapes and sizes. But all the boxes are going to be exactly the same. So if we see 1099 INT on the form, we'll enter the information. In this case, we have interest income coming off of either a savings account, a money market account, interest-bearing checking account. The one unique one we have here, I'll just point out a couple different boxes you may see. Oftentimes, we probably won't see an early withdrawal penalty. That would be if you have a long-term CD or some sort of other time-managed account and you're pulling money out early. What happens is you're going to be counted for interest income, but then you get a deduction for the amount the bank's taking for a penalty. So if you see it, you can just enter it. It's going to come up as an other adjustment on the income tax return. In this case, we have interest on U.S. savings bonds and treasury obligations. The reason why this is separately stated here is because it is taxable for federal purposes. The government does tax the money that they give you, so that's not tax exempt, but the states are not allowed to tax U.S. interest. So if you take a look at your return for this individual, you will have $81 of interest income for federal purposes. If you take a look at your PA return, you're like, I don't know why it says only $56. That seems wrong. It's actually the right answer because Pennsylvania cannot tax U.S. savings bond interest. We don't often see it, but they do have a box for federal income tax withheld. Traditionally, you're only going to see that if someone is subject to backup withholding, that they may have had some issues in the past, or somehow they told the bank that they would like to have tax withholding on their $56 of interest income. Probably not high enough to get into a withholding scenario, but they certainly could do that. So we just need to watch. Every once in a while, you'll see something that pops up in a box you're not expecting. So just as a matter of course, go through the document, make sure all the information's entered. Okay, the next one that's going to be actually in the same area of input on TaxSlayer is going to be our 1099 dividends. These are going to be any dividend and distribution information. So again, these are typically going to come in either two different types of scenarios. One is directly held securities. So we may see people that have stock in a dividend reinvestment program or held through an agency account, and all they have is just dividends coming through. They may hold stock directly, and they make it a little coupon-looking thing that is a 1099 DIV. What we want to take a look at is there's a couple of pieces of information in here that are really going to be important. One, ironically, the box 1 is probably the most important of all these documents. It's going to let us know how much we have in a distribution. So for a 1099 DIV, you'll see that there's a box 1A. That's going to tell you the total amount of dividend distributions. Now, the fortunate part with dividends is there's a special rule in the tax code that allows a slightly lower tax rate. And when I mean slightly lower, it can be as low as 0% on qualified dividends and long-term capital gains. So I'll kind of just briefly mention that capital gains are actually an advanced topic, which we'll talk a little bit more about in week 5 if you go on for advanced certification. But the government allows any type of qualified dividends, meaning that you've held your dividend for a qualified period of time, to be taxed at a lower rate than your ordinary income tax rates. And the reason that we can understand these is they're actually reported in box 1B. So as long as you enter that information in, what will happen on your income tax return, you'll see that the dividend income is $1,256, but when we go to apply the tax calculation, we'll actually get a benefit. This is all behind the scenes. You don't need to look at it. Now, just bear in mind, if you have a client that has a high amount of qualified dividends or long-term capital gains, and they have taxable income, but they have no tax, tax layer's probably not broken. It's probably doing the calculation correctly. If you think there's an error, we can certainly take a look at it, but usually it's a known error that we'll be getting all kinds of warnings to say tax layer can't calculate taxes here. I should probably knock on wood because we don't want to have any of those issues happening. But you may see situations where the tax does not appear to be high enough based on income, but that could be because they have a lot of qualified dividends or long-term capital gains. So perfectly acceptable that these tax rates are going to be a lot lower. A couple other things we may see if it's not a directly held security or through a dividend reinvestment program, it may be coming through a brokerage account. We have a couple clients that come in with a relatively larger stack of documents that are all coming from a consolidated account. Could be from a financial broker themselves, could be from an online type account like a Vanguard or a Fidelity, but they may have a little bit more information. So you may see a consolidated 1099, which will have a 1099 interest on it, 1099 DIV, and again, when we get to the advanced topic, a brokerage statement that'll show gains and losses of securities. Now, you also may see things like capital gain distributions. These are typically coming through when people hold a mutual fund that might have other underlying investments. So if there's capital gain distributions coming through, that'll be reported in box 2A of the 1099 DIV. Again, these are going to be subject to that lower income tax rate. So they may be entirely reported, and you may not see a 1099, a new form coming up that we'll see is an 8949 as a sale of stock. Schedule D, you do not need that if your only information is just coming out of a dividend distribution. So if you see the information on here, again, enter it as you see it. Most of the boxes that we have are actually going to be within scope. So if you see it presented here, all we have to do is simply enter it into the tax return with the boxes numbered, and it'll automatically flow to the correct areas. Typically, we don't see a whole lot of difference between federal and state for dividends. The one thing PA will do is they'll move those dividend distributions into the dividend category just for state purposes. So if you're trying to tie that out between federal and state, which we'll talk about a little bit later as well, just as a reminder, they may not be exactly the same number showing up. So we'll kind of teach you how to go through that process. Okay, one of the other ones that also has a 10-9 and a 0 in it is a 1099-G. The ironic part is the 1099-G can contain a lot of different information. So the 1099-G can actually be a refund of state and local taxes coming through from either traditionally here in our area, either the Commonwealth of Pennsylvania or Lancaster County Tax Collection Bureau. Again, if you get one of those, it may or may not be taxable. The only reason that it would be taxable is if the taxpayer had itemized deductions in the prior year and received a benefit for payment of state and local taxes. Now, we'll probably see a few less of these become taxable for a variety of reasons. One, we're seeing a lot less of itemized deductions. Two, we're also seeing a limitation on total itemized deductions based on state and local and realty taxes. So there's a cap now for all individuals of $10,000. So if you had a property tax bill of $8,000 and you had $5,000 of state and local income tax, Normally you'd say, I'm pretty good at math, 8 and 5 is 13, I'll have a $13,000 deduction, but it's capped at $10,000. So you can only have a $10,000 deduction. If you filed your return the prior year and out of that $5,000 state and local, you had a $100 refund coming back, that refund is no longer taxable because you didn't get a benefit for that additional amount. The only way it would be taxable is if you itemized in the prior year, you took itemized deductions, and you had less than kind of the full $10,000 allotment. In that case, you did receive a benefit from the overpayment, and that would be taxable. I think we're going to see very rare circumstances of where this can apply for VITA. So you may see people bring a 1099-G in. Again, it's probably not going to be taxable in most cases, but we still want to take a look at that. The other 1099-G we may get is coming off of unemployment compensation. So again, anything that you get in terms of earnings off your own money, earnings for your time and labor, or getting paid not to work are taxable items. So 1099-G is going to be reporting our unemployment compensation. Again, as long as you're not the first one at your site location to enter this, it's a lot easier because once the 1099-G is entered, then all the information will populate. You don't have to worry about which address is it on Boa Street in Harrisburg or what's the long zip code. As long as the first person got it in there correctly, you'll be all set. What we're going to see here is a 1099-G showing our unemployment income. And what we'll see is it's going to be unemployment compensation again in box 1. Typically, we're not going to see any other types of information in here in terms of state or local tax refunds, anything else. We do want to watch. This is typically a form where we will see federal withholding. Most times unemployment is pretty good about reminding recipients that it is taxable income. So quite often if they have significant amount of unemployment, they probably have federal withholding on it as well. So we do just want to double check to make sure box 4 is complete and we enter that information in on the return as well. Again, all we have to do is find box 4 in the 1099-G, enter the information, and we're going to be good to go. Okay, getting a little excited here on the, oh geez, all right, there we go, okay. One of the most popular ones we're going to see, particularly if you're in an area that has a high amount of retirees, will be a 1099 SSA. So this is an SSA form coming from the Social Security Administration reporting Social Security benefits. So what we have here is a typical SSA 1099. The information that we typically need from this document will be coming out of box 5. This is the one time that they don't follow their rules, and box 1 is the most important one. Most of our information is going to be showing up a little bit later. Box 1, ironically, is a name. I don't know why they changed their format. Every other 1099 has names under what they call the name category. But 1099s for SSA has changed it, so box 1 is actually the taxpayer's name. What we'll see is their social security number is in box 2, again, just to identify taxpayer or spouse. The benefits paid in 2000, this was a little bit older, 2015, is there for informational purposes. It helps us reconcile how much has actually been received by the taxpayer. The one that we're most concerned about is actually the one that'll be in box 5, which is a light magenta. I'm not quite sure the exact color. I did not do well at art history, but is kind of an off color, which makes it a whole lot easier to find. It's a little kind of pinkish hue to it that will sometimes, if they photocopy it, becomes very hard to read because now the document now is grayed out. But that's the number that we're concerned about. That's the number we want to use for purposes of entering into our tax system. Fortunately, the SSA entry is very, very simple. It is pretty much finding the SSA form, determining whether or not it's a taxpayer or spouse, and enter the amount from box 5. We do want to take a look at the description of amount in box 3 because there's sometimes information there that can be applicable. Oftentimes, if the individual has had things like Medicare insurance withheld or supplemental insurance, that will show up in box 3. The important part for that, you can actually enter that as well right into that system. So it'll allow you, if the taxpayer may itemize deduction, it'll automatically flow and allow us to take itemized deductions. There may be a couple other things in there. I think for the most part, most of ours are fairly straightforward. And typically we're going to see kind of your Medicare coverage for drugs or other supplemental insurance in there. Every once in a while, we may see that there have been some other withholdings or some other adjustments. Now, you do want to double check. It doesn't happen all that often, but every once in a while, we do have clients that have voluntary income tax withheld on Social Security. So we don't want to forget that. That's actually in box 6. So there's usually kind of what we'll see is in the upper right-hand corner of the form in that light magenta-ish probably have to get a better, if anyone's from Easton and goes to Crayola, let me know what that color is. I can probably describe that a little bit better. But there's going to be a big blank spot between that and the federal income tax withheld. It'd be nice if they actually had them right next to each other, so it'd be a whole lot easier to remember. But you may just want to double check if they have any federal income tax withheld. Generally, for individuals who may be retired and they may know that they owe some federal taxes, instead of making estimated payments, they may decide it's easier to just ask the Social Security Administration to withhold taxes. And that is generally the best place we'll see that. So typically we may see them either withhold out of Social Security or coming out of the next document that we have here. Kind of we discussed last week, I should say, if you take a look at the return and the return looks a little bit different from the prior year and maybe the withholding wasn't as high, one of the things you may want to do is go back and double check and make sure you have all the withholding from the documents. I think the SSA is the one that you might not see as often. So don't overlook that. That's kind of buried down a little bit deeper, but oftentimes can still be there. All right, so another thing that we want to take a look at, another area very popular for retirees, and I'm going to mention also unpopular for non-retirees. So this may pop up in a variety of circumstances. One's not so bad. The other one we'll talk about in just a little bit why it is not so good. This is a 1099-R. This is a distribution from a pension, annuity, retirement type of account. So this would be anything coming out of a 401k, 403b, 457 plan, an IRA, a SEP IRA, Roth IRA, non-retirement annuity. So virtually any type of plan that's either an annuitized plan or a retirement-based plan, any distribution is going to show up as a 1099-R. Again, now we go back to the fun part where box 1 means something again. So that's going to be the amount of gross distribution, and we'll talk about tax layer will automatically assume what's in box 1A or box 1 will be the total amount of taxable distribution. So it's going to fill that in for you. If there's something different in there, if there's something different in box 2A, or they clearly have a 0 in there, you want to go and be sure you enter box 2A. Otherwise, box 1 will automatically flow to 2A. A couple other things we want to take a look at. You'll see that under box 2A, there's often box 2B. There are two different areas that can be checked. One is a taxable amount not determined, basically meaning that the third-party administrator is not entirely sure whether it's taxable or not. We'll talk about how to handle that situation. Same thing for total distribution. That's generally not a good sign. Total distribution, meaning they've completely wiped out their account. Typically, we're going to see that with something in box 7, which I'll warn you about, and then we'll discuss in a lot more detail. Oftentimes, we will see withholding on 1099-R distributions, particularly if they're an early withdrawal. So box 4 is going to be critical. Typically, if you have an early withdrawal from a retirement account, they're going to ask that you have 20% withheld. I'm just going to let you know right now that people will tell you that they were never informed that they needed withholding on that amount. The default position is 20% on an early withdrawal. They had to proactively tell their third-party administrator, I don't want 20% withheld. Inevitably, they're going to come in and say, no one ever told me that. I was not aware that there was any type of tax on here. I don't know why they didn't tell me. So we'll kind of tell you how to deal with that. We'll also make sure you have some Kleenex around to help through the discussion process. Hopefully it's not something we see all that often, but we will show you how to address it. So box 4 will be letting us know how much they had in federal withholding. The next couple ones that are going to be in scope here for our basic returns are pretty much going to be box 7. And that's going to indicate our distribution code, which we'll talk about in probably 23 seconds, because I'll change the slide over and we'll talk about what our major distribution codes are here. So box 7 is going to indicate kind of the area in which how that distribution will be treated for federal and even potentially state income tax purposes. So the codes that are going to be in scope for you here are actually on the next page. And also you'll find a copy of this in the D39 with a little bit more detailed explanation about what each of these codes are. We'll start off with the bad ones. Code 1. Code 1 is kind of an area that we know that there's going to be a lot more issues with this return now. It's a early withdrawal from a retirement plan, and there's no known exceptions that apply. Generally means the recipient is under the age of 59 and a half. So we often see this in contexts where someone may have changed employers or the employer's stopping their plan. They may say, you have been working with us for a little while, you're now moving on to a different employer. You have a couple thousand built up in your retirement account. What would you like to do with it? Option one is you can roll it over to your new employer plan and make it part of that plan. Option two, you can roll it over into your own retirement account, like a IRA. Option three, you can take the cash today. I'm not quite sure if they actually go in that order, because whenever the recipient hears, you can take the cash today, that's the plan that they think makes the most sense. So they may have a little bit of cash build up, a couple $1,000s, or they may have another IRA or 401k plan and they decide that that's the best place to go get some additional cash. Most 401ks will not allow hardship withdrawals unless there's a specific reason. But if you have an IRA, you can take money out of that at any point in time without any reason or justification. So if you see a code 1, it typically means the recipient's under 59 and a half. Not only is anything on the 1099-R taxable, it's also going to be subject to a 10% penalty. So it's going to be taxable income and subject to a 10% penalty, and it gets better. It's also going to be taxable for Pennsylvania and local purposes as well. So a regular distribution for 1099-Rs is not taxable for PA, but an early withdrawal would be. Now it gets a little bit more complex because an early withdrawal is only going to be taxable to the extent of earnings on the plan. And I will warn you, when you ask someone, well, how much of this distribution do you have that it represents your contributions? If you recall back when we talked about the W-2, Pennsylvania did not give you a deduction for the amount that you voluntarily put into your own 401k. So the amounts that you put in come back tax-free. So if you put $1,000 in your 401k and it grew to $1,500 and you withdrew the entire amount, you're not taxable on $1,500 for Pennsylvania. You're only taxable on the $500 of earnings, or the $500 that your employer may have matched. You're not taxable on your own monies coming back to you. Problem is, most people can't tell you what they put into their retirement account. The benefit we have, hopefully if it's a situation where someone may have only worked for a very short period of time with the employer before they decide to pull their money out, we can take a look at their W-2s. If they brought in their W-2s, anything that says code D in box 12 was their contribution. So it makes it very easy for us to go ahead and come up with that amount. If not, these returns might take a little bit more time to work with. Just to warn you, if you think the return's going very well and you pull up the 1099-R and there's a code 1, it will probably not take you 5 more minutes to finish this thing off. It's going to take a little bit more time. In fact, it may be entirely permissible that we have the taxpayer come back with more information if need be, including copies of prior returns or other documentation from their employer. But just to warn you, the code 1 is the one that doesn't feel as fun as the rest. Code 2 is going to be similar. Code 2 is also going to be an early withdrawal, usually someone under 59 and a half. However, in this case, they know that an exception applies, that the penalty will not apply in this scenario for federal purposes. This could be something like it is a transfer of funds due to a qualifying domestic relation order in case of a divorce, or some other issue that they know the penalty doesn't apply for an early withdrawal. Again, for state purposes, this amount will be taxable, but we're going to recover our cost basis first. So anything that's a code 1 or code 2 will be coming up as a taxable for PA. Just to let you know, whatever is taxable for PA is also going to be treated as taxable for local purposes. And we'll kind of talk a little bit about how that will be entered a little bit later today. Now we get into the fun parts. The things that are going to be taxable for federal, if you recall, these things will always be taxable for federal purposes, except if we see a rollover of an account. So code 3s and codes 4s and code 7s, while there's no penalty attached to them, will still be taxable for federal purposes. So they're still taxable. These are not taxable for Pennsylvania though. So you'll see in the state and local tax column, not taxable. Code 7 is probably the one we'll see the most often, particularly for retirees that are coming in, taking money out of their IRA, their pension accounts, their annuity accounts, 401ks, non-qualified retirement annuities. Code 7 means it's going to be taxable for federal, but not taxable for PA or local. And once you get the information in the tax layer, it knows not to take it over to local or Pennsylvania. It's just going to simply have it taxable for federal. The code G and the code H are going to be ones in which we have a direct rollover. So it's actually rolling from one provider to another. If you recall, the first option we had with your 401k is to roll it from your prior employer into your new employer account or from your prior employer into your own IRA, those are going to be code Gs. They're going to be a direct rollover. We still need to report the information. So don't just hand the 1099 back and say, hey, good, not taxable. We don't need to worry about it. You still want to enter that information in the 1040, put a code G down. The tax layer will put it in and designate it as a rollover so it knows it's not taxable. Code Q, we're going to see a few more of these as people are starting to have distributions from Roth IRAs. This code would be in scope. It means a Roth IRA. Those are handled a little bit differently. You do not have a deduction for money going in. Benefit is you don't pay any taxes when it comes out. So if you have a withdrawal from a Roth IRA that is completely tax-free, it's going to have a code Q, not taxable for federal, not taxable for state or local. We do have one down here as well, which can crop up on occasion. If you see something that has a letter and a number, it's probably not a misprint. You can actually have multiple things happening in the codes. The most common one we're going to see is going to be a 7D. And what the 7D represents, this is a non-retirement annuity plan. And what we mean by that is if you have a, typically operated by insurance companies, potentially a bank, where you will take some funds that you have set aside, you give them those funds and they will return to you either a termed annuity or life annuity, where you give them a set sum of money up front and over a period of time they will make payments back to you, generally with a guaranteed rate of return. What this represents is part of that is your own money coming back to you. Part of it represents earnings. Because this is a non-retirement annuity, this is basically a purchased investment product. It is considered for Pennsylvania purposes interest income on the amount that's considered earnings. So if you enter a code 7D, there'll be a little technique we use to get that to show up in the right area. I believe if we put it in the state distribution box, it'll actually show up in the correct area and show up as interest income on the Pennsylvania return. So the code 7 is applicable for federal purposes, meaning it's a normal distribution. Non-retirement annuities can fluctuate. They may be taxable in full, then maybe none of it's taxable, maybe only part of it's taxable. It all depends on how much earnings they have from the plan for that time of year. Whatever's shown up in box 2A, the taxable amount will also be taxable for Pennsylvania purposes as interest income. The good news, it is not taxable for local. Local tax can only tax earned income. So this non-retirement annuity is an investment product. It's not a earned income element. So just want to give you an overview of the codes, and then we'll kind of hop back into a couple reporting issues. Again, what will happen is tax layer by default will take what's in box 1 of the 1089 and assume it's entirely taxable, which saves you a couple keystrokes and making sure you don't retype the number incorrectly. It's going to assume that whatever's in box 1 will be taxable in box 2A. However, there can be amount in 2A that may be different than box 1. And that's entirely possible. Again, we talked about the non-retirement annuities. There may be some cost recovery of basis in a couple different plans. If there is an amount in box 2A, we want to go ahead and enter that in. So whatever is sitting there, we want to enter it as shown. Now, what may happen is sometimes you'll see that there's nothing in box 2A, and the box 2B is checked to say taxable amount not determined. And you may think, oh, okay, this could be an issue. Hopefully not an issue, because what it basically means is the third-party administrator is not aware that there's any amount of after-tax contributions or any other types of issues there. So basically what we have to ask the taxpayer, if there's an amount in line 1, box 2A is blank, and that 2B is checked to say taxable amount not determined, you can ask them the question, did you make any after-tax contributions to your Roth, your 401k, your 403b, or thrift savings plan? And you'll usually be met with a look much like most of you have here. What in the world are you talking about? That's a good response because it means that they have no idea whether or not they had done it, which generally means they didn't do it. You have to, again, be very selective in understanding that you put money in outside of the normal system into your retirement account, that you did this with after-tax dollars, or you made a non-deductible IRA contribution. So you should hopefully be aware that you've already done that. If they did not do it, if they have that blank look to say, I have no idea what you're talking about, that's a good sign. It means they probably didn't do it and the entire amount will be considered taxable. It just means that they may have rolled money over. Typically, you may see this with an IRA because they may have changed brokers and the broker has no idea what the prior information was. They just took that prior amount and started investing it. So this does happen a little bit more often than you might think. But typically what will happen, we just allow box 1 to flow automatically into 2A and become fully taxable. If they say, no, I absolutely put after-tax dollars into my retirement account, you say, well, thank you very much for coming in. Appreciate getting the opportunity to meet you. You take all the documents, you put it back in a nice little bundle, and you push it back across the desk to them. We cannot handle that situation. It's a relatively complex scenario because it means part of their distribution is taxable, part of it is not. And they're going to have to go outside the VITA program. So that's outside scope if they come back and say that they do have some after-tax contributions or that they have a non-deductible contribution to an IRA. That puts it out of scope for our purposes. Now, when we take a look at a Roth distribution, we kind of mentioned the Roth code. Roth IRA distributions you can always take the amount that you originally put into your Roth tax-free. So again, it's kind of you're recovering your own cost basis. But what we take a look at are the entire distribution is going to be tax-free if you meet certain conditions. And that's where the code Q will show up on the 1099-R. If the distribution you made was 5 years after the very first contribution. So once you make your first contribution, your 5-year period starts at that point in time. It's not every contribution, it's just on your first one. The distributions after you reach age 59 and a half, due to disability, due to a state beneficiary, or to pay certain first-time homebuyer expenses. So there's a qualifying reason why you're taking it out. Usually age is the one that's going to be our biggest one there. If you meet those two conditions, it's going to be a tax-free Roth distribution, code Q. If it doesn't meet those, and there's another code in there, like a code J, then it means that the distribution can be partly taxable. And again, much like if they made after-tax contributions to a retirement account, we cannot handle anything that may be partially taxable. It's a little bit more complex. I say a little bit, it's actually a lot more complex than what we want to be able to deal with. Even outside CPAs don't really enjoy working with that because it's a lot of work to come up with a number that is trying to get to the most accurate answer. Okay, so going back to our early withdrawal, just to kind of reinforce some topics there. Again, this is kind of like the Kleenex, unless we don't get, I don't know if we get royalties from Kleenex. In that case, it'll be called the facial tissue response. So it is going to be one in which they're taking an early withdrawal. Again, we're going to see that this is going to be a federal taxable item plus an automatic 10% penalty. In most cases, what's going to happen is that 10% penalty is going to be added in automatically. There's no additional entry that we need to do. What we also will take a look at is, again, we mentioned Pennsylvania and local will also need to get copies of that information that they will tax the earnings component. So the earnings are going to be anything the employer put in, so the employer match, or earnings on the plan. Now, this does come out what we call cost recovery basis. So if you haven't had a full liquidation of your account, your contributions come out first before earnings. So as an example, if you have a total IRA account that's worth $12,000 and you have $6,000 of your own contributions and $6,000 represents earnings and employer contribution, and you take $5,000 out, $5,000 is going to be taxable for federal. It's going to show up as a code 1, taxable for federal, 10% penalty. For Pennsylvania purposes, none of it's taxable because you have the first $6,000 coming out of the account is your own contribution. So the first $5,000 that comes out is your own dollars, not taxable. If you take money out after that, you only have $1,000 of your cost coming, and the rest of it will all be taxable. Now, oftentimes people just liquidate the account because it's a whole lot easier to say, I'm going to, instead of transferring that 401k, I'm going to take the whole thing in a check. Or I'm going to go ahead and just liquidate the IRA because it's easier while I'm in here just to cash the whole thing out. So we may not have to worry about partial liquidation, but just to kind of make you aware, it's a cost basis rule first. So your original contributions come out before anything else. Now, a couple things that may arise. There may be some reasons why people have taken an early withdrawal from their retirement account. And again, what we're going to suggest is you probably talk to them and ask them if there is, how did you use the funds from this early withdrawal? We don't want to try and guide them and say, hey, good news, we have a bunch of exemptions here that you might qualify for. Let me go down through the list and ask which of the following may or may not apply in your specific situation. We don't want to guide them, but we don't want to also prevent them from taking the benefit of any exclusion items. But we do want to probably ask, I noticed that you had an early withdrawal from your retirement account, and they say, yeah, they never told me it was taxable, and they never told me I had to have any federal withholding. As a reminder, 20% would have been automatic. So they were told it was taxable. They were told that they'd have to pay federal income tax. They probably didn't know about the state and local because the third-party administrator won't tell them that. But they should have known at least it was taxable for federal. Or they may say, well, I took it out for a specific reason. We have a couple reasons that they can be exempt. So if there is a code 1, the penalty is going to automatically apply, but we have the option within TaxSlayer to go ahead and tell them that all or part of that may not be subject to the penalty. This is penalty relief only. It doesn't make the distribution tax-free. So I think, unfortunately, a lot of people get the idea that they hear that, oh, you can take money out of your retirement account and pay for your home. You can take money out of your retirement account and pay for your college education, for your children or for yourself. Well, sure, you can take money out of your retirement account for anything. It's all going to be taxable. The issue is whether or not there's a penalty associated with it. So there may be a couple situations that we see, and we have 4 codes here that could be applicable within VITA. The ones I think we'll probably see a little bit in a more common application. When I say common, we probably don't see all this very often, but the ones we do see will probably fit into one of these 4 categories. Now, the first one that we see here, code 5, can be from any type of plan, a 401k, IRA, other type of plan. If you have significant medical expenses, so this is unreimbursed medical expenses that exceed 7.5% of your adjusted gross income, and you take monies out of there, again, you have to be under 59.5. So if you're over 59.5, there's no issue with a code 1. So this is someone under 59.5 that may have excessive medical bills. So it has to be in excess of what would be our exclusion item for itemized deductions. The amount that's above 7.5% of your adjusted gross income will allow you to reduce your penalty. And it's penalty only, it's still going to be taxable income. But those can be coming from any accounts. The next 3 codes, code 7, code 8, and code 9, are only allowed from an IRA. And you can tell if it's an IRA when you take a look at the 1099-R. In box 7, there's a code that goes there. There's also a little check box next to that box 7. That'll indicate if it's an IRA, SEP, or simple plan. If it's an IRA, SEP, or simple, then code 7, 8, and 9 can apply. So if you have an IRA and you take a distribution for health insurance for uninsured individuals, the penalty may not apply to the extent that the funds were used for payment of medical insurance for an unemployed individual. Only to the amount that you've actually used it. So if you took $8,000 out of a plan and $3,000 went for insurance, then $3,000 will not be subject to the penalty. You'll still have penalty on the full $5,000, and the $8,000 is still going to be federal taxable income, in addition to potentially state and local. Code 8 is the one that we see that people take a look at and say, oh, hey, I was told that I can take this money out for college. You could. Again, it's going to be taxable. So anything coming out of an IRA only. It can't come out of a 401k, 403b. It has to go to an IRA. And typically most employers, because they're still sponsoring the 401k, 403b plan, will not allow you to take money out of that plan without some other reason. However, you can always roll your 401k into an IRA, which makes it self-directed, so then you can pull money out for whatever purposes you want. But if you take money out of your IRA and you use it for things like tuition, fees, books, supplies, room and board does count in this context as well. So sometimes you may see people taking money out of a 401 out of a IRA for college. Most college expenses we take a look at for the credit does not include room and board. But if you take money out from your IRA and you use it for room and board, that will allow you to avoid the penalty, not the tax. It's always going to be taxable. So there's no tax-free withdrawal from your retirement account to pay for college. The last one we have here, it's an IRA distribution. Again, it has to come out of an IRA, which is why it's bolded and in large block letter there, for a first-time purchase of a home up to $10,000. The first-time home purchase is a little odd, as you can probably tell from last week. The IRS doesn't exactly mean what they say when they give us definitions. For example, a child can mean various things under various sections of the code. First-time home buyer does not literally mean the first home you've ever bought. It means the first home you've ever bought in a while. I don't know why they don't do a better definition, other than if they probably said for purchase of a home, and people say, I'll just keep buying homes. I'll keep taking money out of my retirement account. So it doesn't mean necessarily your very first starter home that you've ever bought. If you haven't had a home in a while and you buy one, it can still count. So there's a little bit more area that we need to take a look at there. Again, what I probably suggest when you see these codes, if someone says you see a box 7 code 1 distribution, and you just ask, so I see you've taken money out of your retirement account early. Was there a specific reason, or was this money used for something why you took the money out? And if they say, yeah, I wanted a flat screen TV, and I thought it'd be nice to take the kids to Disney. Okay, well, we don't have a code for that. There's no like code 11, like trying to be a good parent. That's not a valid reason for getting a penalty exemption. And again, all of it's going to be taxable for federal. It's going to be taxable for PA, going to be taxable for local. What we're trying to do is avoid potentially part of that 10% penalty. So again, we want to be able to encourage them to take advantage of if it applies, but we don't want to force them into it. Again, we don't want to sit down there and say, I have a whole list of codes here. Let's go through and see which one may make sense. You don't have the time for it, and it gets to be a much more difficult conversation. Okay, so one of the other things we wanted to talk about here is kind of segueing into our local return. So the one unique aspect we have is, first of all, a lot of the information within our IRS material doesn't cover state. So if you notice that there's nothing in the 4012 that covers Pennsylvania taxes. The unfortunate part, Pennsylvania is one of the odd states that doesn't follow federal tax rules. If you worked in Maryland or New York, guess what? They follow federal. You start with federal AGI and you're pretty much good to go. Pennsylvania follows a completely different set of rules, which we'll get to in a few weeks. But we did want to kind of mention some things about local. So IRS doesn't tell you anything about state, and they certainly don't know anything about local. So that's why we want to give you a little bit more information here. So one of the things we take a look at is we mentioned we may see some local impact for 1099-R distributions. So if you have an early withdrawal from a retirement account, that may be impacting your local return. So for Lancaster County, the Lancaster County Tax Collection Bureau, or typically LCTCB, which is what you'll probably see on a lot of the checks, which sounds like a frozen yogurt type place or something along those lines. It's a whole lot easier to write LCTCB than write out Lancaster County Tax Collection Bureau on the check, unless you have one of those giant publisher clearinghouse size ones. But what we're looking at here, if you reside in Lancaster County or part of the Octorara School District in Chester County, so that's kind of their jurisdiction, Lancaster County plus a little carve out on Chester County side, I guess for you guys would be on this side. If I'm drawing Lancaster County, this little part here, would be all part of the territory of Lancaster County Tax Collection Bureau. So if you lived in this area, again, Lancaster County or Octorara School District for all or part of 2019, and you had one of the following: any earned income. So basically, if you had any wage income, that's considered earned income. So that would be subject to Lancaster County Tax Collection Bureau taxes. If you had any net profits from activities in self-employment, meaning that you had a sole proprietorship or you were active in a partner activity. If you had distributions from a retirement account that were an early withdrawal, they're all subject to Lancaster County Tax Collection Bureau. This only applies for individuals age 16 and older. So every once in a while, you may see a situation where a person brings in a return and says, oh, by the way, I have a W-2 from my child. They had a summer job. They worked at the local community center. And if they had the tax withheld, they can actually apply to get a refund if they're under the age of 16. Or you may see a W-2 for a child and their local wages don't match the state wages. And that maybe they turn 16 throughout the year and they actually had the correct amount withheld once they reach the age of 16. So one thing to keep in mind, if a client brings in a pre-printed Lancaster County Tax Collection Bureau form with their name and address on it, we have to send something back to Lancaster County Tax Collection Bureau, even if they don't have any earned income. So Lancaster County has them on their register and rolls, and we'll be expecting a return from them. If they are retired, if they are disabled, if they are no longer working, you can indicate that on the form. Hopefully they take you off. The past couple of years, I kept checking deceased on mine, but they keep sending me one anyway. So apparently they must double check the record somehow. But if you do get a pre-printed form and you do not send it back in, Lancaster County will send notification letters out at the end of the season, typically well after we're back in kind of late summer, Labor Day mode, and we get a lot of notices coming into the VITA Center to say, why am I getting this thing from Lancaster County that's going to charge me $25 per name on the return? Why I didn't submit a return? So if there is something that they have, we want to be sure that we actually submit that back. couple things that can help us out. We do have a school code. So oftentimes, if you're asking people information, you say, hey, by the way, which municipality do you live in? They can help you with the street address. They may understand that they live in Lancaster County in the Commonwealth of Pennsylvania, but they may not know if they live in East Earl Township, New Holland Borough. They may not know exactly what school district they're in. So one of the things we can do is go through what we call a municipal lookup code. If they have a pre-printed return from the prior year, it's good because the code's already on there. If they don't have one, or the first time they're here in Lancaster County, we want to go ahead and look up that code and verify where they're at. So we actually have a website here, which is pretty easy to use. I think it's actually linked on all of the VITA computers in the browser. You can go ahead and pull that up. If you do have a situation where you have no earned income, again, you can select the box to say why you don't have any earned income, retired, disabled, no longer working, deceased, that type of thing. If you do have any local wages, we'll talk about how that'll work within the TaxSlayer program. We can actually prepare these things by computer now, no longer done by hand. So can save some time, and your penmanship isn't put to the test here for local returns. Again, as we mentioned, a retiree may need to file a final return. If you do get a pre-printed form, you do want to go ahead and submit that back. Just check the reason why you don't have any earned income and have them sign it. Typically, they will remove them from the rolls at some point in time, but we do want to make sure that they come off from our rolls. We do have some local return resources. I think, as Jesse had mentioned, your Google Drive, if anyone's been able to locate that and utilize it yet, we do have resources for very specific topics, and local returns are one of those. So if you have questions about local returns, we have a local information fact sheet, a couple other areas within there that can help provide information, including, as he mentioned, kind of a calculation for a blended tax rate. So if an individual moved throughout the year, most of our tax rates in Lancaster County are a flat 1%, but there are a couple others that are a little bit tricky. There's a difference between Lancaster City and Lancaster Township. Warwick School District has a slightly different rate, and Solenco, if I'm not mistaken. All right. No one else changed them yet, so I think we're okay, right? Okay. It is, yes. So once you're in, you're in. Once you're out, yeah, you can't get back in again. All right. So those are the ones that we kind of have to watch. The interesting part, especially with Lancaster City and Lancaster Township, you may not know exactly where you kind of cross over between the jurisdictions. So it's important to use that municipal lookup if at all possible. So I think what we'll do now is we'll actually take a break here for questions, and then we'll kind of hit a few local issues coming up in a bit.